Well, hello again. Welcome to another Saturday family training. If you're new with us, my name is Dave. I'm your Regional Vice President. And today I'm kind of excited about what we're going to be training about. But first, we have two banners. One is dedicated to Jesus, and I'm happy about that one. The other one is dedicated to you. This is an award for last year for we're part of the championship team because of double-digit growth in part of our business. And part of the reason for that, you are the reason for that, but part of the reason for that is the gentleman standing behind the camera. And so I'm going to ask him to come and stand in front of the camera for a moment.
Hello there. Social distances?
Yeah, social distancing, that's right. You know, our elbows are probably going to break out with COVID-19, but Iwan has been a real valuable part of the region, as most of you know, and he hasn't stopped. He's continuing to grow. He's getting ready to take the Series 65 exam, and I'm sure he'll pass that as quickly as he did the 26, 6, and 63. So now you can go back to behind the camera.
Thank you.
Congratulations.
That is my place.
That's your place. It's my place too, but I don't have enough sense to stay there. But today, we're going to be talking a little bit about investments. And most of what I have to say about investments is in the way of warning. So let me do a little drawing. This is going to be tough. I'm not a great artist. Let's see if I can do it. I did it. It's a box. And I want you to know that inside this box is everything that you are allowed to say about mutual funds if you don't have a securities license. Meaning you pass the 6, you pass the 63, and you got a welcome letter from Primerica saying that you are legal to go. This is what you're allowed to say about mutual funds, including, surprising to most people, the words mutual funds. So I don't want you to use the words. I don't want you to talk to people about investments. I don't want you to talk to people about rate of returns except where it appears in a presentation. Now, if you are life licensed, you are allowed to do the presentation for families. And of course, you probably know by now that those presentations are being done by us over Zoom, and Zoom is perfectly secure, so you can contact the family, you can set up an appointment. It's very easy for them to get onto Zoom. All they have to do is go to zoom.us, as in United States, zoom.us/download. And then they can download Zoom. There's no cost to it, unless they're going to start doing their own meetings on it. Please don't do that either. But once they have downloaded that, then they are able to do presentations for families. And I highly recommend that you do that if you are life insurance licensed. Now, if you're life licensed, you are also able to do fixed annuities. So you can talk about fixed annuities, you can recommend them to the clients, you can set them up with a fixed annuity over Zoom, but a fixed annuity is not a security. Securities are specifically investments with the property that the investor could gain, the investor could lose. That's the primary characteristic of a security. And some people are very, very squeamish about the possibility of loss. And so I say, well wait, I don't want to lose anything. I need some kind of a guarantee. Well, then fine, set them up with a fixed annuity. If you're life licensed, you can do that. There's also some training. It's just a few hours. It's very simple. You can do it online, and you need to complete that training in order to be able to talk to people about fixed annuities. So enough about that. Real investments. Real investments You know, when I first got involved in this business, and don't worry, I'm not gonna start talking about a bunch of old stories about when Columbus, you know, discovered America. But when I first got involved with Primerica, on the securities end, I was one of the very early ones to get a securities license. Even my RVP at that time didn't have a securities license. But when we got securities licenses, we taught buy term and invest the difference. We threw everybody into the same mutual fund. Mutual fund was well managed, and you know, praise God, the thing kept returning, because if there had been a big disaster, we'd have all been in deep yogurt because we just tossed everybody into the same place. My advice: don't do that. If you have a securities license, there's one word that's going to keep your butt out of jail. I'm going to write the word up on the board. Suitability. That's the word. Suitability has two parts. In fact, they're important enough for me to put them up here. Number one, making sure that the investment meets the client's objectives, their investment objectives. Okay? And secondly, the investment meets their risk tolerance. I'm going to talk to you about both of these because this is huge. As a matter of fact, if you put somebody into an unsuitable investment, yeah, they probably won't come after you. They'll probably come after me. And so I'm saving myself in talking to you about this. But let's take a look at number one and number two. Number one, making sure that the investment meets the client's objectives. We're going to talk in a few minutes about a hierarchy of risk in investments. Different investments, I'm sure you know, have different amounts of risk. And if you put a client into something that, let's say that they're 32 years old, they've got 35 years before retirement age of 67, and they've got, because they've got all sorts of time, why put them into a very, very conservative fund that has a very low characteristic rate of return? They don't need a 3% rate of return. They need a big rate of return so that they'll have a 7-figure IRA account by the time they retire. And so for the person who's young and wants to retire successfully, most of the time, and I'll show you in a minute why I mean most of the time it's not a good idea to put them into a very conservative account. On the other hand, let's suppose that you've got a person who's 69, 70 years old. I can relate to that. And they're really worried. Don't put me in anything that has any risk, because I don't think I can afford to make sure that you have guarantees. Mutual funds don't have guarantees. If they need a guarantee, go back to the annuity idea. But if they suppose that there's a person who's just panicky about the possibility of loss, do you put this person into a small cap, and we'll talk about that in a few minutes too, small cap mutual fund that's invested in international stocks and what? No, you don't put them into something that's very risky. If a person is worried about their investment, then you put them into something that's more conservative. That has to do with number two. The investment has to meet the client's risk tolerance, their ability to tolerate risk. Now, let's suppose that you have somebody who's 70 years old and they're like me. I love to take risks. I don't care about stock market losses. I've lived through a whole bunch of them. I plan to live through a few more of them. So I invest as riskily, is that a word? I invest as risky as I possibly can. But that's me. I have money to back it up. I love to take the risks. It's an adrenaline rush to me. But most people my age aren't like that. That's why when Doug Hartman gave his input to the company about the investment profiles that you see in the securities applications, thank Mr. Hartman for that, because he was the one that came up with that. The beginnings of that questionnaire. So we need to find out how much money do they have. Do they have money to back up any potential losses in their investment? Would they be in a panic if the stock market were to go down for, say, 3 years at a time? All of those things have to do with their risk tolerance, their ability to tolerate risk. And that's why those questions are in all of the securities applications. So you don't have to worry about it as much as you might think, because they are all in the applications. If you ask the questions honestly of the client, and they answer them honestly, and you total up the points in those applications, then you'll find out what their risk tolerance is, and it will recommend a certain kind of portfolio for them, a certain kind of investment. If you stick close to that recommendation, you're going to be okay, and I'm going to be okay. But if you wander from it, let's suppose that a client is like me. They're 70 years old. I'm not quite 70 years old, but you know, as mathematicians always used to say, I'm within epsilon. But if you're old enough and you answer those questions truthfully, and then it recommends this kind of a portfolio. And if the investor says, well, I don't want that kind of a portfolio, I'm like Dave, I want to take risks. Well, then you get a note, handwritten, that's signed by the client that you recommended this portfolio, but they want that portfolio. They want this kind of a mutual fund. If you get that and it's signed and dated by the client, then you can put them wherever they want, because the client is always right. Right? Okay. So suitability is the biggest thing in investing for your clients. Now, I promised to tell you a little bit about that hierarchy of risk. I'm going to assume that the person watching this video is not tremendously experienced in investments. A number of you are, so this would be boring, except someday when you're an RVP and you've got to teach this class, it'd be a lot easier to copy down what I said and to have it in your notes than it would be to come up with it yourself. I have literally thousands of pages of notes that I've taken from Mr. Hartman, from Art Williams, from Joe Plumeri, from all of our CEOs, from Glenn Williams, from my senior vice presidents, everybody. I have thousands of pages of notes. You think I'm clever enough to come up with all this stuff myself? I've learned this stuff from all of those notes. And so remember that a good successful Primerica person is a good student. You learn from the people that you follow. Now, here's what I call the hierarchy of risk. And I'm going to leave lots of space, and I'm going to come down here and start with money markets. Now, some people would say, well, Dave, where would you put cash value life insurance on this hierarchy of risk? Cash value of life insurance is not an investment. It's not an investment. Now, some of you are knowledgeable about securities and say, wait a minute. Yes, it is. Variable life and variable universal life, those are investments because the word variable means they got securities in them and all that kind of crap, right? But the problem is that those separate accounts that variable life and variable universal life possess don't belong to you. And it says in the prospectus, we, meaning the insurance company, own the proceeds of the of the separate account. So you get the risk, the insurance company keeps the investment. We told you last time that's pretty cold-hearted. But life insurance is not an investment. Not an investment. Term isn't, whole life isn't, variable life, and none of them are investments. So they're not going to appear on this table. The first one I want to put there is a money market. Dave, what about a CD? Certificate of I usually call a CD a certificate of depreciation. A certificate of deposit is not an investment. It's a place where you can put the money. The principal is guaranteed by FDIC insurance, and there's some provisions to that even. But there's that is an investment, because in theory you can't lose the money, so it's not a security. So I'm starting with money markets. Now, what is a money market? A money market is investing in cash. It's investing in cash. Now, what makes up cash? They invest in CDs. So if you put money into a money market mutual fund, for example, we're going to talk about the difference between a money market fund, a money market, and a money market mutual fund. But if you put the money into a money market mutual fund, then is there the potential for loss? Yes, it is a security. It's possible to lose. But they invest in very, very safe investments. They invest in CDs. They invest in what are called bankers' acceptances, very safe kind of IOUs. They invest in things where it's not likely to lose the money. What's the purpose of putting money into a money market? And the answer is to protect principal. Now, by the principal, I mean the amount that they invested. Okay? If they have $100,000 or they have $10,000 and they want to save it someday to buy a house. Now there might be somebody in Arkansas listening saying, $100,000, you can buy a house. Well, we're doing this video in California. The only kind of house that you can buy here for $100,000 has the word Rover on it. It's a dog house. It's usually in the backyard. But suppose they've got some money that they want to save up to buy a house. And I will always ask them, well, when would you like to buy this house? And they usually say, well, in a year, year and a half, something like that. You do not put money into some risky stock fund if they want to invest for less than 3 years. 3 years is my rules. If you turn in a stock fund and it looks like the purpose of that is for them to save money for college for a kid who's 16 years of age, so they want to save the money for 2 years, and you turn it into me, I'm going to reject the trade. You can count on it. It isn't going to go into Virtual Base Shop. I'll hand it back to you and say, no, you need to put them into something more conservative. Okay? Remember that everything that you invest for a client has to pass through your RVP. And that's why we're there, to protect the client. Now, if they want to protect the principal, they want to save money for less than 3 years, I'll take those all day long. What's the upside? Protects the principal. 2 downsides. Number one, there is a hand-to-hand relationship between risk and potential reward. And notice that I said potential reward, not reward. We're just a few miles away from Orange County. Years ago, there was a fella, I don't want to tell you his name, but his initials are Robert Citron, and was a fella who was kind of in charge of the money, and the Orange County invested in some very risky bonds. Well, the reason that people invest in very risky bonds is because they want to, they want to get a high rate of return but they like a little bit of security from the fact that it's bonds. Those are called junk bonds. And so the county invested in these junk bonds. Well, guess what? Junk bonds have a higher probability of the company that issued the bonds going belly up. And darn if they didn't go belly up. And so did the county. Orange County declared bankruptcy. This is a long time ago, but you know, the county went belly up as well. Why? Because the ratings on those bonds were very low, and they were very risky. So where would you put somebody who really needs to protect that principal? The answer is you put it into a money market. Now I promise to tell you the difference between a money market and a money market mutual fund. What is a mutual fund? First of all, it's something that you don't talk about unless you have a securities license. But here's what a mutual fund is. Now you're allowed to invest in it. I highly recommend that you do. You know, we want people who practice what they preach. If you preach, you know, buy term and invest the difference, and you have a need for life insurance and you don't get your term insurance from Primerica, well, you know, shame on you. You know, you ought to do that if you qualify for it. But investing the difference, if you have money to be invested, put that money into a mutual fund. What is a mutual fund? It's many people combining their investments, pooling their investments in order to get a higher class investment. And so when you put people into a money market mutual fund, that mutual fund invests in lots of different money markets. And so they're more diversified. Okay? So there are advantages to investing in a mutual fund that has the same risk tolerance as maybe a stock or a bond or a money market, because the mutual fund, with millions of people pooling their resources, they have more money to be able to diversify, to be able to help protect against loss. Is it protected against loss? No. If you get a money market at the bank, then it's FDIC insured. It's protected against loss. But if you put it into mutual fund, yes, it's a security. Yes, there's a possibility of loss, but it's not very likely if it's in a money market mutual fund. The purpose is to protect the principal. Now, let's go up the food chain just a little bit. Let's talk about bonds. We used to have one of our wholesalers. I think she's still around. Her name is Joyce Bond. And I got a chance to dance with Joyce one time, but she used to introduce herself by, the name is Bond, Joyce Bond. If you're not a 007 fan, you have no idea what that means. But bonds come into two varieties. Number one, and I'm going to put this down here, government bonds. And then a little distance higher, I'm going to put corporate bonds. The reason that I'm putting that higher is because we're doing this in terms of increasing risk. Okay? Now, a government bond. What is a bond? A bond is somebody borrowing money from somebody. That's all a bond is. Okay, somebody's borrowing money from somebody. And one of the things that I always feel bad about, I've been in numerous Primerica trainings where the people say, well, the kind of interest you can earn in a mutual fund, and immediately my brain shuts off and says, you don't earn interest in a mutual fund. But you can earn interest in the individual bonds, for example. Now, here's how this works. The government, there are two kinds of governments. There's the federal government, And I think you all know what that means. That's Uncle Sam. The federal government, does the federal government borrow money? Well, since our national debt is currently in the 20 trillions, my guess is, yeah, maybe they borrow money, okay? So the federal government borrows money from the people. They have to pay interest to the people. And when they pay that interest, that's the investor's desire. That's their objective. They want that interest income. So maybe for somebody who is 70 years old and wants to start earning income, well, you'd put them into something that pays interest, like government bonds. But we offer government bond mutual funds. Now, there are several kinds of government bonds, and we'll do the specifics when we do a securities class specifically, but generically, these things are offered by the United States Treasury. The Treasury borrows money from the people. They do it with Treasury bonds, Treasury bills, Treasury notes. All of those are the government borrowing money from the people. They pay interest for that. That's federal. Now there's another kind of government. It's called a municipal government. Municipal comes from the old Latin word munis, meaning city. It's a state, county, city, and local authorities. Let's do those one at a time. We're in California. Every time we have an election, California is proposing this bond. It's because California wants to borrow money to do something. It might be to upgrade the schools for earthquake protection. It might be, it might be to be able to pay employees more. Whatever is the purpose, the state of California borrows money from the people, state bonds. Then counties can borrow money from the people. We're sitting in LA County right now. Los Angeles County borrows money from people, and those would be LA County bonds. Los Angeles, the city, can borrow money from the people, okay? A true municipality. And finally, those local authorities. Now, when I was a kid, we used to travel across the country. And as we traveled across the country from New Mexico, where I lived at that time, we'd go across the panhandle of Florida, and the panhandle of Texas. That'd be quite a jump to go from New Mexico to Florida. But we'd go across panhandle of Texas, and we get to Oklahoma. And then you'd get to the Oklahoma Turnpike, and you'd get to the, I think it was called the Tulsa Turnpike. But these turnpikes had authorities. You have the Turnpike Authority, and they would borrow money from people so that they could build and maintain those turnpikes, and then they'd have to pay the people interest. So those authorities, here in California, we have the port authorities. Port authorities can borrow money from the people. It's called a municipal bond. And so let me put that up here. Very often heard them called munis, municipal bond. That is a state, a county, a city, or a local authority borrowing money from the people, and they have to pay interest. Now, what are the advantages of such things? These are still, they're low on the risk profile here. Why would anybody want, say, a municipal bond? The answer is municipal bonds are federal income tax free. Tax free. And so any money that you earn from that municipal bond, you're not going to pay federal income tax on it. Now you might pay state income tax on it, but not federal. On the other hand, if you get a federal government, if you get a treasury bond, then you are going to pay federal income tax on it, but you're not going to pay state income tax on it. Now tell me, would you rather not have to pay federal tax or state tax? Personally, my federal income tax is a whole bunch bigger than my state income tax. So if I got a municipal bond, then I wouldn't have to pay the federal tax. Now, you can get mutual funds with municipal bonds inside. Okay, so they might invest in a dozen different municipal bonds, maybe dozens of them. And so what that does is each municipal bond has a certain maturity date, so you're not putting all of your money into one place with one maturity date and then poof, you've got to get back your principal or something. The maturity dates will be staggered. And so that's one of the advantages of getting your municipal bonds, or for that matter, your federal government bonds, your treasury bonds, getting them through mutual funds. A mutual fund staggers the maturity dates and gives you more variation on and a little bit more risk protection than just investing in the bonds, the individual bonds by themselves. Does that make sense? So, I hope it makes sense. Now, corporate bonds. They're just what it sounds like they are. A corporate bond is a corporation borrowing money from the people. Now, why in the world would a corporation borrow money from the people? Why wouldn't they just have another stock offering and raise more money? Well, think about it for a second. If a corporation has a certain number of shares of stock out there, maybe they've got 50 million shares of stock that are out there, and then they issue new stock, then what that does is it dilutes the investment of the people who have already invested, because, well, I used to own 7% of the company, now they issued this new, this new public offering, and now I'm down to owning 4% of the company. And that may not please people. Now, there are preemptive rights. We're going to talk about that when we do a real securities class. But for right now, you don't always have, if you're a corporation, you don't always have to issue new stock to get money. You can borrow money from the people. So you do a corporate bond offering, and people buy those bonds, and now the corporation owes them money. They eventually have to pay back the principal. But the reason that people buy these corporate bonds, excuse me, is because they want that income coming in. Okay, maybe they've retired from their job and they need a source of income. Well, Social Security is going to take care of them forever, isn't it? Yeah, so maybe not. So they want some other source of income, and so they say, well, let's invest in a corporate bond, and they're a little bit more risky on the whole than government bonds. Now, if you invest in a corporate bond mutual fund, then you get that same kind of spread and that same kind of diversity, and so it helps protect against loss. Does it protect against loss? No, because mutual funds can lose, all right? But it helps protect against the loss by diversifying the maturity dates, etc. Different kinds of bonds, different ratings of bonds. Some of them are very highly rated. You can imagine how highly rated a Primerica bond would be versus, Schwartz Electronics in West Covina. And I hope there isn't a Schwartz Electronics in West Covina. Otherwise, there will be a lawyer watching this video soon. But investing in a bond of a large company that's highly rated would be a lot less risky than investing in a small company that could possibly go belly up and is low rated. Okay, so a mixture of those can give people a better rate of return. Why a better rate of return for a lower rated bond? Because remember, there's a hand-to-hand relationship between risk and potential reward. If you're willing to take more risk, you have more potential reward. Not necessarily more reward, remember Orange County, but more potential, all right? So a little bit riskier, a little more potential reward, well, sometimes that pays off pretty well. Corporate bonds, those are corporations borrowing money from the people, okay? Now, bonds are very often, of course, they're often called debt because the organization, either corporate or government that issues the bond, owes that money They're also called, what else are they called? I'll figure out what else they're called. Stocks are called ownership. They're also called equity. The word down here is obligation. You have general obligation bonds and different kinds of things, but they are obliged to pay the money back. Now with stocks, you're investing in the stock of a company, you own a part of that company. You actually own the part of that company. So that company is not, a sole proprietorship owned by an individual. Our company started off that way. And we had a stock offering, and then we were bought by another company, an American can company that wanted us. And then we started buying companies, and then we issued our own stock, #1 stock in 2010 in the entire nation. But when the company issues stock now, they are willing to split that ownership among all the shareholders. I own shares of Primerica stock. I think it's a good investment. I'm not pushing that stock. You invest in whatever you want to invest in. But when you own stock, you own part of the company. That's why it's called equity. That's why it's called ownership. But there are a couple of generic classes of stock. And the one I'm going to put down here in the bottom is common stock. And the one above that I'm going to say is preferred stock. Now let me see if I can articulate the difference between those two. The easiest way to tell you the difference between preferred and common stock is to tell you what preferred stock is. Preferred stock is preferred for two different reasons. #1, if that company's board of directors declares a dividend, that preferred stockholder is going to get that dividend. Now there are times, and again when we do the securities class, we'll delineate all those different exceptions. There are times when the company has a terrible year and they can't pay a dividend this year. Well, but they were planning to pay a 5% dividend, and this year they got creamed and they didn't make any profit, so they can't declare a dividend, because that's what a dividend is profit. And so they can't declare it this year, and so they postpone it. And then they'll pay, maybe a double dividend the following year. But some way or another, if you buy a preferred stock, the reason that you buy that is, yes, you want ownership, but you also want income. You want those dividends to be paid to you, okay? So again, the person who needs an income, but they don't want to be this conservative. They want to roll the dice a little bit, but they still want the dividends. Well, preferred stockholders get those dividends. #2, preferred stockholders are preferred in the sense that if the company liquidates, if the company goes belly up, who gets the resources, who gets some of their money back? Well, as you go up the food chain here, if you invest in government bonds, then if the government goes belly up, then you're kind of high on the food chain to be able to put in a claim to get some kind of assets back. But the higher you go up, if it's a corporate bond, you may or may not, because you may have a secured corporate bond, which means exactly what it says. It's secured, so it's backed by stuff. If the company makes widgets, then you might not get your money back, but you might get 100,000 widgets, but somehow or another, your investment is secured. You're gonna get, in fact, I should put this one down lower. So my apologies to those who are taking notes in ink. A secured bond, you have a little bit of protection against loss. But an unsecured bond is called a debenture. An unsecured corporate bond is called a debenture. Now, you know my old joke. I used to think that a debenture was something that you got from your debentist, but no, it's a debenture is an unsecured corporate bond, meaning it's not backed by stuff. It's backed by your faith in that company's ability to make money. And that's it, okay? Now, with preferred stock, you would be, if the company goes belly up, you would be able to get money back or assets back before the people who invest in common stock. These guys would be the last one in the food chain. That's why, and I should have put them up higher too. So I'm going to do this the old-fashioned way. Going up the food chain of risk, common stock is riskier than preferred stock simply because if the company goes belly up, these guys get paid before these guys. If you buy common stock, there's a good chance that you're not going to get your money back at all. And so you're kind of last in the food chain. This is what I call the hierarchy of risk. Is it all inclusive? Not by a long shot. There are options, there are derivatives, there are warrants, there are all sorts of other things, there are other ways to invest. Within stocks, you can invest in companies of different sizes. For example, you can invest in what's called a large cap stock. This is a company that has a lot of cash, billions and billions of dollars in cash. Then there's a mid cap, has a little less, still in the billions, but low billions, okay? And since these numbers have changed since I got involved, I'm not going to give you a number, but then you can invest in a small cap company. Now, question, do you think it's riskier to invest in a large cap company like Primerica, or is it better? Is it more risky to invest in a small company like Schwartz Electronics in West Covina? It's riskier to invest in the lower company, in the smaller company, because they're more likely to go belly up than the big Titanic company. Although, don't forget that the Titanic sank. Okay, there's always risk in investing. Now, this has to do with stocks and bonds and money markets, but we don't sell stocks and bonds and money markets. So why did I bother to take you through all this stuff instead of just going through what we sell? The answer is you have to know this for two reasons. Number one, you ain't gonna pass the securities exam unless you know this. But number two, this is what those mutual funds are stuffed with. Pardon me, ending that sentence with a preposition. This is what's inside those mutual funds. They're stock funds, bond funds, money market funds. There are funds that are mixtures of all of these. You can have a preferred stock fund, which is often called a growth and income fund, because growth for the purpose of ownership, but income, well, preferred stocks will give you the income. So a growth and income mutual fund might be invested largely in preferred stock, might have some common stock in it, might actually have some bonds in it for the income part. They're widely mixed. Now, what's your job as a securities license representative? Your job is not to know all of the 7,000 mutual funds that Primerica offers. I don't even know what the number is now. Thousands of mutual funds that we can offer. Your job isn't to know all of those. Your job is to have certain funds that you like that take care of every possible objective and risk tolerance. So, how many growth funds should you have? Well, you should have some that invest in small cap companies, some that invest in international companies, some that don't invest in alcohol or tobacco, so-called social awareness companies, some that have some mid-cap. I set my wife up with a mid-cap fund about 20 years ago, and she can't believe how much money is in it now. Well, it was a wonderful fund, very well managed. Now, the mutual funds, therefore, have a whole mixture of things. But if it's a growth fund, specifically a growth fund, its primary investment is going to be in stocks. In fact, generally in common stocks, because they're more likely to grow. Why? Because they're a little riskier, more risk, more potential reward, right? And so a growth fund would have mostly common stocks. You can have an aggressive growth fund, which is going to invest in smaller capitalization companies. You can have less aggressive. You can have semi-aggressive. All stock funds are kind of aggressive because the company is not obligated to pay you anything back. You can gain a fortune, you can lose a fortune. And of course, many people in 2008 lost a fortune. So that's kind of the picture of securities. Why should people invest in mutual funds? Are there advantages to mutual funds? Why don't we just get all of our people Series 7 license and let them go out there and sell stocks and bonds? There's a reason. How's that for a cliffhanger? There's a reason, but I'm not telling you what it is. No, I will tell you. Advantages of mutual funds. Now, the astute watcher will probably notice that I left this side blank for now. The reason is there are disadvantages to mutual funds. So we better take a look at both, just to be honest. In fact, folks, in that regard, our company founder was an absolute fanatic for doing what's right. As a matter of fact, this is a direct quote. Folks, dadgummit, you better do what's right, right? He always wanted us to do the right thing. You always tell the truth 100% of the time. You do what's right 100% of the time. And he used to say, if you don't do what's right 100% of the time, you may get by for 1 day, 1 week, 1 month, or 1 year, but sooner or later, they're going to smell you out. That's exactly right. So how about golden rule with investments? You do with people what you would want your broker to do with you. Is that a deal? So now, let's see what the advantages are of mutual funds. Diversification. With mutual funds, you can diversify. Are all mutual funds diversified? No, they're not. Diversification is a very specific, the specific word in the securities business. It has to do with how much of the company that mutual fund can own. They can't own too much of a single company. They can't have more than a certain amount of their proceeds, the amount of cash that they've got. They can't have more than a certain percentage invested in any single company. Those two provisions make up diversification. And so for a mutual fund to be a diversified company is kind of a high-class thing. It means that you're spreading the risk. You don't take as much risk. Could it lose? Yeah, but you're protecting against what's called market risk. Diversification. When I was a kid, we used to have Easter egg hunts. My mom used to put out the eggs and everything. My dad generally didn't want to get involved with all that stuff, but my mom, you know how it is, mothers. By the way, happy Mother's Day. You know how that is. You put out the Easter eggs, and my brother, we had an Easter egg basket. Each one of us had an Easter egg basket. And one year, my brother, now I'm sure it was by accident, he stepped in my Easter egg basket. And guess what happened to my Easter eggs? They became scrambled eggs. And so what was the message of that? I shouldn't have put all my eggs in a single basket. Well, with diversification, with a mutual fund, you're already putting your eggs in lots of baskets. Some people say, well, I better have lots of different mutual growth funds. That you don't need, because if you have one growth fund, your eggs are probably already in 100, 150 different baskets. You don't have to worry about diversifying your mutual funds if the mutual fund is diversified. Does that make sense? So diversification is one of the advantages of a mutual fund. If you're buying stocks in a company, that's pretty hard to diversify. All my money's going into Apple. Well, they don't slice that apple up into slices, you know. I mean, you're investing everything into one company. But with a mutual fund, not so. Number 2, liquidity. Liquidity means that you can turn that mutual fund into cash quickly. As a matter of fact, by law, if you have money in a mutual fund and you want to liquidate that money, okay, I've met my objective, I need the money now. You want to take the money out? The mutual fund has to, within 7 days, have that money in the mail coming toward you. It's the law. So it's highly liquid. You can liquidate your account very easily. Now, related to liquidity, but separate, is what's called marketability. Now, if you have money in a stock, an individual stock, and you want to sell that stock, what do you have to find? A buyer. You have to find a buyer, somebody who wants to buy that stock. Now, that's usually done through a stockbroker, but one way or another, you got to have somebody buy it or you ain't going to sell it, right? Well, because a stock may or may not be marketable. It may or may not be something that somebody else wants to buy. But a mutual fund, not so. It's 100% marketable, because when you buy shares of a mutual fund, the mutual fund has to be the buyer. When you want to sell it, they've got to buy it. So you instantaneously have a buyer. If you want to liquidate it, you can liquidate it. So this means you can get your cash real quickly. This means there's somebody to buy your investment. And the somebody is the mutual fund company itself. Okay? What else? A mutual fund is professionally managed. There are these people called investment advisors who manage these mutual funds. And so they make the decisions like, okay, buy this stock, buy that bond, sell this one over here. They're making those decisions day after day. These people know their craft. They do this all the time. And a lot of times your investor, who might be mom and pop and they're teachers and they don't know very much about the stock market, they don't want to track these stocks. They don't want to track their investments. They want somebody who's professional to do that. Well, that's what these guys do. The person who manages the mutual fund, usually the person is a company that manages the mutual fund, well, they're making those decisions all the time, and so your investor doesn't have to make those decisions. They're professionally managed by people who know exactly what they're doing. And so there's another beautiful advantage to a mutual fund. We're going to talk about this in the near future. I don't have time to talk about it today, but it's called dollar cost averaging. And dollar cost averaging works like this. I'll give you the generics. In the future, I'll give you an example. But dollar cost averaging is if you invest every single month at the same time of the month. Personally, my favorite number is 17, so I invest on the 17th, okay? But if you invest at the same time every month, whether the market is up or the market is down, it lowers the average dollar cost of your investment. How does it do that? Well, when the market is up, the money that you already have invested, well, praise God, that's worth more money. When the market is down, well, praise God, you bought more shares because it was at a lower price. So you just keep investing the same amount, a couple $100 a month, $50 a month, whatever you can afford. You invest at the same time every month. If the market's up, you're praising God. The market's down, you're just praising God all the time. Okay, so that's what happens with dollar cost averaging. Now, another feature, we're going to talk about this in the very near future too, is retirement plans. Mutual funds qualify for an IRA, both kinds, the traditional IRA and the Roth IRA. We're going to be talking about the difference between those two in the future. They qualify for 401ks and 403bs and 457s and excuse me, all the different kinds of plan, 529s if you're saving money for a child, UTMAs if you're saving money but you don't know if they're going to go to college or not. There's all sorts of different ways to signify that you want some kind of a tax break for your mutual fund investment. We're going to talk about those tax breaks in the future. But all of those advantages, and there are more, I don't have time to talk about all the different advantages of mutual funds because I want to talk about the disadvantages of mutual funds. Number one, we've mentioned several times. Number one, they're not guaranteed. Is it possible to lose all your money? Yes. Now, can you protect a little bit? Can you lower the risk of a mutual fund? Yeah, you do that by diversifying. It's part of your asset allocation. And part of that's done by these guys. Part of this is done by your Primerica agent. But one way or another, you can help protect it, but there's no guarantee. So if a person wants a guarantee, I hate to say this, it almost makes me sick to say this, tell them to go to their bank, okay, if they want a guarantee. Or if you're really good at fixed annuities, there are actually some guarantees with some variable annuities, but remember, if it has the word variable in it, you can't talk about it without two licenses, life insurance license and securities license. So be careful about the word variable. Fixed annuities, they're not investments, they're not securities. You can talk about those, you can sell those all day long, not a problem. I hope you do, okay? Now, the other disadvantage is most mutual funds have sales charges. Now, I'm a nice guy, but I don't do what I do for free. I get paid to do what I do, and I get paid on the investment end from these sales charges. I don't get the whole sales charge. The sales charge is divided into two areas, the dealer's concession and the underwriter's concession. We'll talk about that in the future as well. I get paid from the dealer's concession, and we'll see how that works in the future. But those are really the two disadvantages of mutual funds. They're not guaranteed. You have to pay to do it because folks like me don't do much for nothing. Okay, but that's the end of our training time today. And next time, I'm really looking forward to next time. I've got a number of things I want to talk to you about, but alas, my time is up. So God bless you. Have a good, now don't forget, Thursday night, invite people to that Zoom broadcast. I told you earlier in this broadcast how to get Zoom if you don't have it. Invite people to that Zoom broadcast at 7:30 p.m. The code number is always the same, 714-518-5940. It's actually the main phone number at our Primerica office. But stay tuned for that on a Thursday night. Invite as many people as you can to watch that thing because many of those people are going to end up in your organization. So long.